The problem with trading big paradigm shifting events with non-linear inflection points is that it's very hard to see or spot those inflection points ahead of time, and timing is crucial. One way to mitigate this, or essentially a crucial component of a trade structure in this case, is that the trade itself must be positive carry. That way, while you wait, you can generate income and afford the opportunity to wait for that inflection point. This leads me to the trade structure that I find very interesting, which is a risk parity type of trade between US cash treasuries and Japanese yen futures or Japanese yen forwards. The first leg of this trade is the Japanese yen. Essentially, shorting the Japanese yen, the biggest risk that I see is that the world goes back to global recession. If we go into global recession, we can expect central banks across the world to respond by lowering interest rates again, essentially collapsing the interest rate differential between the yen and, say, the US dollar. This would be a cause for the yen to rally, which is the biggest risk that I see to the short yen leg of the trade. Now, one of the first things that are very interesting about the short yen trade is that if you look 1 year out to the currency forwards or the currency futures, you can see that the 1 year out future trades at about 5% premium to the cash price. And this really reflects the interest rate differential. That means you could short a yen future 1 year out and naturally earn about 5% carry as the yen future decreases in value down to spot prices. Hedging the risk out of the first leg of this trade can be found by actually going long US Treasuries. US Treasuries right now yield about 5 to 6% depending on the maturity that you're looking at in the short end of the curve. Now, what's really interesting here is that given the macro situation we just described earlier, there's two ways that the interest rate differential between the yen and the dollar could collapse. One is US interest rates collapse in response to a recession and the Fed lowering rates. The other one, theoretically, is that Japanese yen yields could increase, which also collapses the differential. Even though interest rates are high in the US, if Japanese yen interest rates increase, then therefore the collapse of the differential should cause the yen to rally. Now, because we just described the current Japanese macro situation, I'm making the strong assumption that I don't think rates in Japan can go up at all. So taking that scenario off the table essentially means that pairing a US Treasury bond versus a short Japanese yen future enables you to earn, call it 5.5% on each side of the trade, so a total positive carry of about 11%. And should we go into recession, the rally in US Treasury bond should offset losses in Japanese yen futures, and should inflation continue to be persistent, then the drop in Japanese yen futures from a widening differential should offset any losses on the US Treasury side. So together, you can essentially straddle both scenarios, and it allows you to maintain exposure to the Japanese yen should nonlinearity occur in the depreciation of the yen given the macro situation. If you want to leverage up this trade, you can actually take the Treasury side of the trade and go further out in the duration by going further out along the yield curve, and essentially allowing you to leverage up more short Japanese yen futures, increasing the total carry of the trade. Now, the way that I would do this is I would look at the correlation between treasuries and short yen, and I would also look at the volatility between both assets. The last really interesting property about this type of trade structure is that when we're talking about FX and US Treasuries, we're talking about the most liquid markets in the world. So this is the type of trade that not only provides an interesting return profile, but it's extremely scalable and can maintain a lot of size and allow traders to get in and get out with relative ease and manage a large portfolio.